Hello and welcome to the investment review for April 2013. Hopefully the weather is soon going to show us some mercy and bring with it some sunshine and warmth for a late spring. The new tax year is now here, so early investments into ISAs for 2013 and 14 tax year are being recommended to take advantage of this tax-free investment. Regarding news items, on the 1st of April 2013, the FSA, Financial Services Authority, ceased to exist. It has been separated and replaced by two organisations, the Financial Conduct Authority, FCA, here's their web address, and the Prudential Regulation Authority, the PRA, and their web address is also shown. The FCA regulates firms and financial advisors such as Hearst Financial Consultancy to protect the financial services industry and those who operate within it, as well as, of course, those who make use of it, the consumers. It is funded entirely from levies that they make on firms that they regulate. The PRA is part of the Bank of England and is responsible for the prudential regulation and supervision of banks, building societies, credit unions, insurers and major investment firms. To make some comments as to the budget, it didn't really spring any nasty surprises and was effectively neutral because tax cuts such as increases in personal allowance and the reduction in the corporation tax rate were very broadly offset by increases in revenues such as the increase to national insurance contributions related to revised pension systems which are being introduced 2015-2016. So in the giving hand, income tax, the increased personal allowance of £10,000 was brought forward to 2014-15, but a consequence of this is that the basic rate tax limit for 2014-15 is being reduced to £31,865. For 2013-14, married couples should share ownership and income from their assets as much as possible to maximise their personal allowance and minimise the tax payable on income. Capital gains tax was altered. The annual exemption allowance for 2013-14 is £10,900. Tax rates remain 18% for basic rate and 28% for higher rate taxpayers. So it's suggested that people should utilise the annual tax exempt allowance to liquidate income tax-free each year. If you think this is relevant to you, then please do contact us. And of course, if we think it's relevant to you, we will be in touch. With regard to inheritance tax, the nil rate band is frozen at £325,000 and remains at this level until 2017-18. During a parliamentary debate in March 1986, Roy Jenkins MP stated that inheritance tax is a voluntary tax paid by those who distrust their heirs more than they dislike the inland revenue. So with careful planning, at an early stage, assets may be removed entirely from your estate and directed where you choose. Trust planning involves the use of trust instruments with investment products to pass on capital to beneficiaries, whilst enjoying the use of the income for yourself. And assuming that you survive the 7 years, the tax savings can be substantial. There'll be more on this in our next bulletin, but for those keen to know any more now, please do get in touch. So, whilst the government gave with one hand and took with the other, let's look at state pensions. The introduction of the single-tier state pension will be brought forward from April 2017 to April 2016, which was in fact the original introduction date. When the single-tier pension is introduced, the state second pension will close and contracting out will no longer be possible. This means that a member of a contracted out defined benefit occupational pension scheme and their employer will see their national insurance contributions increase as they start to pay the contracted in national insurance rates. With regard to pension drawdown, a product used by quite a lot of our clients who don't like the concept of being in an annuity, particularly whilst annuity rates are so poor, the good news here is that the government confirmed the increase in the Government Actuaries Department, we call it GAD, limit for capped drawdown from 100% to 120% of the GAD relevant annuity for pension years that started from the 26th of March 2013. It also announced that the Government Actuaries Department has been commissioned to review the pension drawdown table and the underlying assumptions used to provide drawdown rates to make sure that they continue to reflect the annuity market. It's quite a gobbledygook statement, but what in essence it means is that clients in drawdown contracts are now placed back into the position that prevailed before the government changed the drawdown rate down to 100%. It now makes drawdown look more compelling again as compared to annuity rates. It's not a straightforward area of advice and one that we keep under constant review. So having a look at this month's graph, results for the past 6 months show a general upswing in the markets, with Japan showing the greatest gains as a result of the implementation of bold monetary policy easing measures of the newly appointed team at the Bank of Japan. Emerging market equities generally underperformed those in the developed world as a stronger US dollar and generally weaker commodity prices slowed down their progress. To give a broad market commentary, stock markets in the developed world have performed well over the past 6 months, led by the United States, which is showing gradual signs of recovery. Concerns about the euro have arisen again, with the situation in Cyprus reminding us that this crisis is not yet over. The deal reached for a €10 billion bailout to Cyprus has reduced the risk of collapse of its banking sector, but there will be restructuring with significant losses for 2 of the largest banks. Restrictions on withdrawals are preventing a bank run, but are also affecting the flow of money into the Cypriot economy, which is needed to keep it going. For example, payment of suppliers to businesses and staff wages, general household spending. As a result of the actions in Cyprus, a new scenario is unfolding, where any future Eurozone banking problems will have to be solved by funding from creditors and not the taxpayer. Growth is being stifled by debt. Lack of exports leads to falling revenues, especially tax revenues, and where imports exceed exports, debt cannot be reduced until this gap is closed. A problem in the UK is its weakness of exports, and where over 40% is to Eurozone countries, it's therefore reliant on a Eurozone recovery. Emerging markets such as Asia and South America, although not directly involved in the banking crisis, have a heavy dependency on exports to weaker parts of the developed world, such as the Euro area and the UK. Therefore, growth in these areas is predicted to continue, but at a slower rate. Bringing this month's review to close, in summary, we continue to monitor activity in the markets on a daily basis and continue to believe that a diversified portfolio will outperform cash over the longer term. It's not lost on anybody that cash returns are dismal. Compared to the volatility of stock markets, where investors can see the value of their money going up and down, cash investors are losing money in a more subtle way as its purchasing power is gradually being eroded by inflation. It's always, of course, necessary to hold sufficient cash for emergencies, but we believe that if investors are willing to take a long-term view and invest in the markets, they should be rewarded. This is, after all, the basis of capitalism. Since the credit crisis began back in 2008, it has been said that we are in unprecedented times, and in many ways this is true, but in reality we are always in unprecedented times and having to make choices and decisions based on information currently available to us. At Hearst Financial Consultancy, we do not claim to have psychic powers to make predictions, but we do have the knowledge to guide our clients towards the most suitable investment solutions for them. That brings me to the end of this investment review. Thank you very much for listening. The next slide has all of our contact details. Please, of course, feel free to contact us at any time.